Morning, everybody. Happy Thursday. Whoops. Just broke my finger. No, I didn't. All right. You guys hear me okay? We have quite the choppy markets, I can tell you. I just had a lengthy conversation late yesterday with a couple of funds, and I can tell you it's we're in a pretty choppy zone. And one of the things to keep in mind is that ultimately we do break out of these choppy zones, but it's just important to keep in mind that this can continue for some time, and trying to figure out exactly when we snap out of it is challenging, to say the least. So I think, for the time being, the base case has to be that this continues. Once we break out of the ranges, then things will get more interesting. But and that typically sort of builds up. It's imagine like a dam, right? Like a water dam, and the cracks start to appear, and then it just all comes at once. That's typically how volatility goes. In fact, I thought that might be the first chart we could look at today. It's just to look at the VIX. Reminder, the VIX, broadly speaking, I don't look at the VIX on a molecular basis. I just look at it more sort of broadly. I measure it sort of in this sort of 20-ish and below range, maybe even 15 and below, and then sort of between 15 and 25, which is where we're at right now, which is choppy. And then the above 25-ish is where things get a bit dicier. And we're just kind of in no man's land, right? So but again, when it changes, it tends to happen pretty quickly. So at this point, we're going to do a presentation tomorrow, and you guys will, if you are on our email list, you'll receive an email tomorrow as well. And maybe we'll stream it. We might even stream it here on YouTube, but we're going to do a special session tomorrow that focuses more around how to make sense and to trade, if you will, of this latest geopolitical stuff happening. There's some very specific things to look for. That's going to be more of a 30 to 40 minute conversation as opposed to a 10-minute morning review. So I can't do it in such a short time period this morning, but you guys, if you're in our email list, you'll receive that invite for tomorrow. I think it's at 10 o'clock Eastern tomorrow. We do that session. It's a research session, 7 o'clock in the morning Pacific time. So, and we might stream it here on YouTube as well, actually. So anyway, so that's where the VIX is, right? So that hopefully should give you a bit of context. Now, first of all, before we get officially started, I want to welcome everybody here. Welcome. This is Set the Markets, our morning call here. I'm Serge Berger from thesteadytrader.com. I'm looking forward to the next sort of 15 minutes with you guys here. As you know, it's Ticker Thursdays, which basically means that we're going to go through a bunch of tickers that you guys would like to look at as well. So if you have any stocks or anything specific you want to look at, please let us know. We'll be happy to go through those. I've prepared a couple things. Again, yields the VIX is one thing that I think is important here. I try not to look at the VIX on a micro basis. I know some people do, but that's more day trading stuff. I look at more sort of broadly. I do want to talk about yields. This is one thing that I really got wrong over the last couple of weeks, or actually this week, really. It's just this week. So when you look at yields, and we're looking at and this is important for if you're a pure stock guy or gal as well, right? This does matter. So the 2-year yield, which if you are part of our community, you know that we saw it actually break below 3.5% or 3.4 last Friday, I think it was, and I thought that was significant. Then, of course, we had the weekend war, basically, that started over the weekend, I should say, and that rallied yields sharply, and really not something I would have imagined. However, this is the yields are we believe still going to go lower again. It's just sort of a 1 week, maybe it's a multi-week shock. I don't know. And the reason the yields are going higher, meaning bond prices are lower, is because it's a sort of a this may not be the right term, but I kind of look at it as sort of like a war risk premium. Basically, what that means, it's because wars are inflationary. And of course, we never know how long these things last. So, that's kind of the thinking here, is it's inflationary, and that's why yields are higher. It's too early for me to call off the trade. I still think yields go lower on a multi-month basis. I just don't know where we are on a sort of multi-week basis. That's kind of the thing. But I do remain steadfast that if and when we see yields drop back below 3.4%, I think that will be when we could see the equity market wake up on the downside. Speaking of the equity market, and I'm just going to bring up the S&P 500, I just came across a statistic, I think yesterday or the day before, that the range that we are in here right now is actually the tightest range to start a year in something like 3 decades or something. Don't know exactly what the number was, but a long time. And, we're in a 3% range on the S&P 500. If you look at it through the lens of just measuring from bottom to top or top to bottom, it's a bit less, but somewhere between 3 and 3.5% of a range that's now basically been in existence at the very least since, let's call it late November. If you get rid of a couple of hiccups, you can probably stretch it back to another month, but let's call it late November. It's an extremely tight range, and it's what makes it choppy. However, underneath the surface, and this is the perverse part, as we talked about yesterday, I don't know if you were here yesterday, we talked about the fact that the index has only gone sideways is purely mathematically explainable. And that's because, as I keep bringing up, just a 3-month look back here on the sectors, and you can see while tech is down 3.8% and financials are down, which is the 2 largest sectors of the S&P, energy has to be up 23% and materials up 18% just to keep the index flat, right? Now, that's not sustainable, right? So either tech has to catch up and rally, which is possible. I don't see a lot of reason for it, but it's certainly possible, right? So please let me be clear. Or energy has to continue rally at the rate at which it has just to keep the index flat. So I think either way, it's going to get tiring. It's going to wear out the indices. And so I think the likely path of least resistance is probably lower at some point from a volatility shock perspective. I think it's a really difficult call right now because the economy is not falling apart, right? I think this is a difficult call to make. I think what you might have is this and then, kind of volatility, right? Whatever in whatever range you want to draw it, right? I think that's the more likely path, whatever that looks like, and then maybe at some point go higher. I don't know, but I think that's more likely rather than down and then just crash and like go sideways forever. I think the economy is still too strong, unless again things can happen quickly, right? So you might say to yourself, what's the point? What do you do? I think what you do no advice, just educationally speaking. What is I think worth doing is probably be more diversified, right? From a portfolio perspective, because people are no longer diversified. I've been talking about this. If you guys know, I've been talking about this for years now, that the lack of diversification will blow up most people's portfolios, particularly the retirees, at the worst possible time. It's almost impossible to think it won't happen. And that's why I'm making such a big deal about making sure you guys know where your portfolios are at in terms of how they're constructed, because most people don't have a real clue. From a trading account perspective, I think you treat it as a trading year, just like last year. But I think the trading year this year is more sector specific rather than kind of all over the place. So, yeah. So Matt is talking about the 2 and 10 years. So what you're talking about is the shift in the yield curve. I know this is going to get real boring real quick for a lot of people, but I'm happy to quickly kind of speak to that. As a fixed income guy, I will tell you that's what's happening. So if you look at, for example, yields, let's take, for example, the end of January, and where they are today is the 5th, right? Yeah. So you can see that the yield curve, it hasn't, well, let me go back a bit more. Let me just go back to, let's say, February 24th. Okay. So what you see is that the yield curve has actually shifted up, right? So that's what you're talking to, Matt, right? Is the yield curve has shifted up in yields across the curve. We haven't really seen a change in the steepening or the flattening. It hasn't shifted like this. It's shifted up, right? And that's really why the inflationary trade that I mentioned before. Now, again, this is going to get real boring real quick for a lot of you guys, but it really matters to your equity portfolio. Trust me, it doesn't matter for a day trade. It's going to matter. It matters in a multi-week, multi-month perspective. So anyway, hopefully that helps Matt or anyone else that cares about that kind of stuff. Billy typing in LIT. What's the question on LIT? I need a little bit of context. When you guys give us a ticker, please actually give me a little bit of context. Otherwise, it's very difficult to address the question. But what I will do while you give me some context, Bill, is I'm going to do two things. I'm going to take lithium, LIT, and I'm going to type it into our market rover. And actually, you know what? I don't think we have lithium in the market rover in the universe. We should probably do that. Oh, no, we do. Here. Sorry. I thought this different thing. So let's understand the time frame, right? So it's a good question because it's a good trending asset. Then the question is, what's your time frame, Bill? And again, I don't know you, I don't know time frame, but what I do know is that the longer term time frames of this, we measure this as multi-quarter in terms of duration. The multi-quarter time frame is the trend is bullish. But it hasn't been bullish since yesterday. It's been bullish, as you can see, since the green background color since September of last year. And if you guys are, if I don't know if any of you guys are members of our stuff, you know we've been making a big deal about lithium now for some time, right? So the buy signal isn't here. The buy signal from an investment perspective came in September of last year. So that's, I think, important to understand. Okay. From a near-term perspective, from a momentum perspective, it's quite choppy. So I don't think there's a whole lot to do very, very, very immediate term. It's more from a trending perspective, which it seems to be the question. Lithium remains in a bullish trend. And this is the whole commodity theme. And this actually speaks a bit more closely to the energy transition theme that we do in our Heat Seeker product. So if anyone of you guys is looking for a specific, portfolio, mock portfolio for the energy transition, which has a lot of energy trays, including lithium and stuff like that in the mock portfolio. That's probably something you want to look into on our end. But I think the bigger point is really the commodity super cycle that we think is going to be something we will look back at and notice that it has begun now. If we're going to look back at this in a year or two. And this is the chart. I mean, there's a lot of reason here. There's a lot of, way more demand for than anything. And by the way, even wars. And I don't know. We don't know how long this thing lasts. It's actually bullish for commodities, right? Because of the inputs and stuff like that. So anyway, but commodities, the super cycle is there. Lithium is just part of that. So yeah, we think that's a bullish thing. Let's see. Fox. Question comes from Jabu. Fox on the weekly charts. Okay. Well, again, let's look at it from the perspective of what's the trend, right? So the trend is no longer bullish. So this is how our framework is, how we work with it. So you can see that the long-term trend, the bullish trend, started in June of 2024 when the stock was at 30. That bullish trend ended when the stock was at 55 about a month ago, a little bit less, so up 80%. It's now no longer a bullish trend. It's now a neutral trend. So our framework from an investment perspective tells us that there's no reason to own the stock right now. It doesn't mean it's not a short per se, because it's a neutral background color, right? It's not bearish, but it's also no longer bullish. So we have to respect that. Now the question, of course, is what's your time frame? If you're looking at Fox in the shorter term, right, I can tell you this from a momentum perspective, guaranteed, we had a sell or short signal in Fox. There you go. It got a bit choppy, but ultimately we had a sell signal that triggered on the 3rd of February. And since then, you can see Fox is down 15%. So the short term was correct, right? We nailed that, the momentum indicator, and the long term has now changed as well. So this is the difference in time frames, right? You want to make sure you get that. Okay. Yeah, the defense stocks, it's interesting, so you have to, so my experience, Harry, is with defense stocks, it's always, there's a lot of front running. So if you look at defense stocks, let's look at Lockheed Martin, for example, right? This might be a good history lesson for some of you guys that are history buffs. Typically speaking, these kind of stocks tend to be a pretty good leading indicator. They can sniff things out, and they tend to front run. So Lockheed Martin, again, we're not getting a buy signal now because we got it all the way back in December. So if you're just waking up to Lockheed Martin now, just realize that the signal is already up 41%. That's 3-4x that with options. So I have no reason to buy it here because the buy signal came a long time ago, right? So I typically don't jump after these once these kind of shooting wars start because, again, and it doesn't mean it can't go higher, right? So let me be clear. It just means that the best opportunity isn't now, it was 41% ago, right? So that's how I look at that. Okay. TS Long, are you talking about Oracle or CRCL? I don't know what CRCL is. Let me see if that even exists. You probably mean Oracle, right? So I'm going to assume you mean Oracle, and I don't know why that's not showing up, but let's type it in here again. There you go. All right. So let's assume you think Oracle. So again, it's one of those things to understand, right? So Oracle was in a bullish trend for the most part, but that trend ended. So I see no reason to buy this stock. It's not in a bullish trend anymore. In fact, at the very latest, it entered into a neutral trend at some point in December, and the stock is still down 18%. So that's and in fact, it's now in a bearish trend. So that's the red background color. Okay. Now, from a short-term perspective, you might ask yourself, what is Oracle doing in the short term? That's more momentum-based. Okay. From a short-term perspective, momentum, which is not trend, short-term, we received a sell or short signal all the way back on the 21st of October. So I don't see a reason to short it now because the sell signal came all the way back then, right? And the stock since then is down 45%. Does that make sense? And again, I don't know, TS Long, because you're not answering. I don't know if you're talking about Oracle or some other stock. I don't know, but it looks, maybe it was a typo that you had. So that's give me a quick yes, everybody, if you can see the difference between the trend and momentum. Does that make sense? Okay. Okay. Newmont Mining, it's a similar situation. So Newmont Mining, okay. Let's have a look at Newmont Mining. So obviously this is a gold stock, right? Right now, it remains in a bullish trend. Again, a lot of people are waking up to it now. The reality is it's been in a bullish trend since June of last year, and the stock is now up still 117%. It remains in a bullish trend. In the near term, it's choppy. So in the near term, we still have a bullish trend at bullish momentum, which came on the 24th of November, and it's just kind of consolidating right now. So I need to see fresh momentum in order to get in this from a momentum perspective. Okay. Okay. Now, let me just quickly take a step back. Speaking of momentum, okay, and again, you can see Newmont Mining, the latest momentum signal came on the 24th of November. If you guys haven't had a chance yet to sign up for our momentum session, we're doing one today. So if you want to learn how to trade momentum, you can go in and register here. The link is, it's this one. It's thestudytrader.com. event. Okay. That is where you can register for the session where we're going to talk about how to trade momentum. Because momentum, and this is the point, right? Because I see a lot of you guys asking about all these momentum moves. The reality is a lot of these momentum moves you guys are asking about, they're long in the tooth, right? So you ask about Newmont mining now. The reality is the Newmont mining buy signal came, on November 25th, or the Oracle short signal, right? That someone was asking about Oracle before. It's not a short now. I mean, it may be, but the reality is the opportunity to short or buy puts came, as you can see, on the 21st of October. There's some new stuff here right now. So for example, I can show you Coinbase. We actually sent out this trade alert this morning. You can see we had a momentum short signal on the 30th of October. And now we're getting a momentum buy signal. It's momentum, right? Not trend. So again, if you guys want to learn about momentum, make sure you join us in our momentum session. It's later on today at noon Eastern or 9 a.m. Pacific time. So that's what's going on here in terms of momentum. Does that kind of answer all the questions in terms of tickers, or do you guys have any other tickers you want to go through? Be happy to stick around for another couple of minutes. But yeah, that's a brand new one here in Coinbase. Again, remember, this is not recommendations, it's just signals from our process. So hopefully this is helpful for all you guys. Again, if you want to learn more about this, join us in today's session. It's totally free. We're just showing you how we use momentum. But I think the most important thing to really take away from our morning sessions here every day is the difference between trend and momentum. So let's have a look at the last one here, Newsmax. I would be very careful with that stock, to be honest with you, Harry. I don't even know. Oh, we don't even have it in the universe, so I unfortunately can't go through it. Yeah, we don't have it in the universe, Harry. So sorry about that. I would be careful with that stock. It's no pun intended, very newsy. It's very erratic. I personally wouldn't. It's not a stock that I like to be involved with, and it's not we don't have it in the market rover. That's probably the reason why. Oh gosh, yeah, it's a $7 stock. All the more reason. Yeah. Anyway, okay. Thanks everybody. Happy Thursday. Hope it helps. And again, if you want to learn more about momentum, join us in the session. The Coinbase one here just is a new momentum cycle we're getting now as of today. So we'll see where that goes. Bitcoin had a pretty big move, which of course is why Coinbase moved as well. So thank you, and we'll see you guys in the momentum session a little bit later on this morning. Again, I put the link into the chat box. It's thesteadytrader.com/event. Yeah, Christian put it in as well. Thesteadytrader.com/event. Cool. Thanks, everybody, and have a good weekend. We'll be back here Monday morning, and we'll see you guys in the momentum session in a little bit later on today.